Hey, Kyle, it is really good to see you. We have some big news today. Secure Act 2.0 finally passes. This will bring about a lot of changes to retirement account rules. We are breaking down the big takeaways, including some unique opportunities and some changes to tax planning. So, Kyle, again, I feel like I've been hearing about the Secure Act for a very long time. What's new here and who's affected?
Absolutely. Hey, Aaron, good to see you. A lot of changes in the Secure Act. We've been studying this pretty heavily since it came out. We're actually doing a client-only event on covering the details of everything. But to us, we've kind of broken down all the changes, and there's quite a few, into three broader categories. Um, you know, Everyone is essentially affected by the changes in this new act. But really, the three broader categories are the retirees, your pre-retirees, and business owners. Those are the three groups of people that have kind of had most of the changes concentrated towards them. And that's how we can kind of make sense of everything on our side.
Yes. Okay. Good headline. So now let's break down a few of those significant changes. And first on your list here was this new RMD age table for those required minimum distributions. What do we need to know?
Yeah, and this one seems silly to talk about because we still get questions about, is my RMD age 70 and a half or is it 72? But to kind of make it simple, if you're already taking RMDs, your deal didn't change.
Hmm.
But essentially, starting next year, RMD age is going to begin at 73 for retirees and individuals. So you're aging into the RMD system at age 73 next year. And then slowly, I think leading up to 2033 or 35, it's going to be age 75 eventually. So if you're already taking RMDs, don't worry about it. It's probably not going to affect you. But if you're aging in, if you're around 72, 73, you got to pay close attention to when your birthday is because it might be time for you to start taking them.
Yeah, that's why everybody's confused though. It's just changing all the time. It's nice to have you
Yeah.
as a resource, Kyle. So now let's talk about some changes to QCDs, qualified charitable distributions.
Yeah, and we really like the QCD
Right.
concept. I mean, you and I have talked about it for a couple
Hmm.
of years now, I think, and we use it with some of our clients. Really, the concept of the qualified charitable distribution is that you're taking money from your IRA and you're not putting it in your bank account, right? Because when you do that, that becomes a taxable event, basically as ordinary income. But if it's going from your IRA to a qualified charity or a 501c3, it's not going to be taxable to you. So there's a lot of planning opportunities, especially if you're paying money to your church every year, or you've got these set charitable expenses, but you have these RMDs that you need to deal with. This is a way to kind of kill two birds with one stone, get the money from the IRA to the charity without paying taxes on it. Everyone wins.
Hmm. And next that we want to talk about some really interesting changes to 529 plans. Those are those college savings plans.
Yeah, so we are not huge fans of the 529s in our office. We don't work with them too often.
Hmm.
But what we have seen is that people sometimes end up stuck with these 529 plans, or their children are, or relatives, younger relatives are. They're kind of constrained on what they can spend the money on. And there's sometimes you feel like there's no way out, but essentially, with this new Secure 2.0, you can move that money from that 529 to a Roth. Now, there's a couple stipulations. That 529 has to have been open for up to 15 years. You can only move 35,000 out of that plan into a Roth, and it is subject to those annual contribution limits for the Roth every year too.
Hmm.
So, but it kind of opens the door for some folks that may kind of feel stuck with this old product that they had or that they ended up with.
Right, right. That's a big change. So I want to circle back though to those delayed RMDs, Kyle, because of course, when you delay taking out those distributions, that's going to leave you with a larger account balance at death. And Congress did strip the lifetime stretch IRA rules. So now almost all beneficiaries must take out the entire account balance in 10 years. That is quite the tax burden.
Yeah, so it creates challenges for us,
Yeah.
because there's all this tax planning that happens and it needs to be updated every year. When the Secure Act 1.0 essentially came out a couple of years ago, well, that was quite a few changes that we need to account for. This is another set of changes that we do need to prepare for. And this one is for everyone, absolutely everyone. So if you're a pre-retiree, if you are already retired, or if you're a business owner and you manage your own retirement plan for yourself and your employees, there are a lot of doors that have been opened on the planning side, especially tax planning, that when used with an advisor and your CPA or your accountant can really create beneficial situations to you.
Yeah, Kyle, I'm glad you're bringing that up because that is my last question. How do we incorporate those changes into our tax planning to help set ourselves up for success for the future?
Yeah, absolutely. And sometimes when we talk about tax planning, people think that, hey, this is the stuff that I do at the end of April when I
Right.
file my taxes.
Yeah.
That's not tax planning. That's
Right.
the opposite of that. It's what you do throughout the year. It's how you get yourself ready for that next January, February, March, whenever you file. And especially on the business owner side, there are all these credits and incentives that the federal government is offering you simply for operating and managing your retirement plan within these parameters that they've set out. It's as simply as, hey, you follow the rules and you're going to get a nice credit. So it's all about knowing what's out there, what the rules are, and then how can I use these rules to make my situation, my family's, and my employees' situation better.
Right. And having that conversation with a professional sooner rather than later is very helpful when we talk about long-term strategies. So, Kyle, if somebody has questions about that or about this client event that you mentioned where you're breaking down Secure Act 2.0
Yeah.
in a little bit more detail, what's the best way to reach you?
Best way is through our website, firstcoastfinancialgroup.com.
All right. Kyle, thank you very much for your time today.
Thank you, Erin.